Hi, welcome to Planning for Sustainable Coastlines in the United States in an Era of Climate Change, an examination of major policy barriers. This presentation is being given by Chad McGuire, Michael Goodman, and Devin Lynch, all from the University of Massachusetts, Dartmouth. You'll see at the bottom, there is a link to the paper. This presentation is a summary of a paper that we have been provided, that we've worked on together and provided to the conference. You can get a copy of that paper directly at this URL. It should also be made available, hopefully, at the conference site itself, certainly under my name, Chad McGuire. You simply need to go and find my name. It might also very well be under Michael Goodman or Devin Lynch. When we have access to the feed loop site, you should find under my profile a copy of this paper. In addition, at the bottom of the paper, you will also find a PDF copy of this presentation. If, for whatever reason, you're unable to get a copy of the paper that I refer to in this talk, or that we refer to in this talk, you can find it at this URL, which you can simply memorize quickly before I start the presentation. What we're talking about here is we're talking about some of the difficulties. We've identified 3 areas in this talk of policy that has, for unintended consequences, created difficult policy outcomes vis-a-vis sea level rise adaptation as a result of climate change. In terms of why this is a problem, before we talk about the 3 policies specifically, you can see here that on the left, in terms of population centers, one of the reasons that sea level rise and some of the policies that surround proactively dealing with sea level rise is such an issue is because our population centers, most of the people in the United States live along coastlines. You see to the left an example of the Northeast United States, where population centers are aggregated along coastal areas. This is representative throughout the entire United States. That is mostly reflected, what you can see to the right in the table, of economic drivers. You see that because most people live in coastal zone counties, in coastal areas, most of the work we do, most of the value we derive from the things that we do, the value of the goods and services that are provided in the United States, have a strong connection to coastal areas. As a result of that, these preconditions create the reality or foundation from which both human expectations and policy follow. The desire to maintain and recreate these conditions become the focus of both policy development and human actions. Effectively, humans deal with the situation that is before them, and they recreate in many ways those underlying conditions. So, for example, if we all live mainly on coastal areas and most of the things that we do are around coastal areas, then we will work hard to maintain the assumptions about those coastal areas, that they're places to be, places to live, that they're safe, and places to do work. And so when we have situations like coastal storms, hurricanes, etc., natural hazards, as we have, for example, in 2005, Hurricane Katrina, 2012, Hurricane Sandy, more recently in the past few years, Hurricane Rita, for example, when we have these major storm events, we work hard to recreate the underlying conditions. So in many ways, policies sort of work through that filter. So we can have a policy that has an intended and unintended purpose that has nothing to do with sea level induced climate change, but in fact helps to sort of, in an unintended way, support decisions about what humans do in the face of these changing conditions. To put that problem in context, we look at 3 general areas in our work in terms of national policies, and they are public subsidies, the way in which, call them amenities, or in this case, coastal land and the things we build on those lands, the amenity value related to coastal areas, and the mechanisms, the financial mechanisms, mainly the capital investment in these coastal areas, both pre and post hazard. And what we find is that there are a number of policies that deal with all 3 of these areas that have really good reasons for being, but have strong unintended consequences that reinforce the notion of redevelopment and the discounting, mainly the discounting of risk. That then feeds into how we perceive those risks and the actual actions that we take in relationship to those risk perceptions. So to put it simply, if we can think about climate change and sea level rise creating an increasing level of risk along coastal areas, many coastal areas along the United States, particularly low-lying coastal areas. If that risk is increasing, policy, what we're saying is that policy is not going to respond proportionately to that increasing risk. And there are 3 policies we identify in this talk that are more well-defined in our paper that we see as being partly responsible for this disconnect between the growing risks related to sea level induced climate change and the way in which we actually perceive those risks and the actions we take as a result of that misperception. In terms of public subsidies, there's flood insurance and disaster relief. These are 2 national federal programs that we have. In terms of amenity value, there's, the interrelationship between the real estate market, coastal real estate market, how the local municipalities fund local services, mostly through the taxing of real estate value. So that interrelationship in terms of that amenity value. And then also the capital investment mechanisms that we have pre and post hazard. There's an entire field of disaster economics in terms of how these financial mechanisms, you think of disaster relief and flood insurance, how money flows into these areas post-disaster, and how that helps to influence the way in which financial mechanisms operate to support the demand for real estate and also the valuations. And as a corollary to those disaster economics, the risk perceptions, the way in which people then take all of this information in, and it helps them to either discount, either internalize or not internalize that risk. And in most cases, we're talking about discounting the risk. The 3 policies that we're talking about that we call counterproductive policies are federal disaster assistance. The purpose of federal disaster assistance is for the federal government to aid state governments under duress due to natural disasters. It is meant to provide a backstop and a means by which states are not wholly, and those private individuals that live in coastal areas, wholly responsible for the effects of natural hazards. The unintended consequence of federal disaster assistance vis-a-vis climate-induced sea level rise is it provides a de facto 0 premium flood and hurricane insurance to inhabitants of risky coastal areas. Effectively, folks get financial help and financial incentives for developing and redeveloping in risky coastal areas. And that makes it difficult for them to internalize the full risk. And it also provides an overcapitalization in many ways in these coastal areas. We also have public flood insurance through the National Flood Insurance Program. Its purpose was to shift risks of coastal living back towards states and private coastal citizens incrementally via low premiums. There's a whole history to this that's spelled out in much more detail in the paper. I don't want to take too much time because I know I'm limited in the, or we're limited in the amount of time that we can spend on this talk, but back in the late 1960s, it became apparent that many coastal areas were experiencing storm events, hurricanes, etc., and they were receiving a lot of damage, and the federal government was providing federal disaster assistance. They wanted to, it was getting expensive, and they wanted to shift some of that burden and risk back onto the state, local governments, and the private citizens so that they could help incorporate a more even decision-making process when thinking about purchasing of coastal property. But in order to do that, they moved in a way that limited the amount of obligation or burden placed on those private individuals by subsidizing the premiums. Effectively, a commission went to private insurance companies and asked them to actuarially determine what would be appropriate premiums to pay in these risky areas, and the premiums were cost prohibitive. And so the federal government made a choice at that time that they were going to pay for most of, heavily subsidize the cost of coastal flood insurance, and made it a public program because they really couldn't get private insurance companies into the game. And that certainly is the case today. And so what we ended up with is we have federal disaster assistance, which still exists. And then we have also a small modicum of private investment where homeowners have to pay a below market premium in most cases, especially in the most hazardous areas, in order to have flood insurance, which provides them with an additional level of protection. And those two things combined have, resulted in the purpose versus the unintended consequence. And in the case of the NFIP, you have this shifting of coastal development risks to the federal government. So it hasn't really disincentivized coastal development, and it actually has provided an additional layer for many individuals at a relatively low cost relative to the actual risk for people to continue to develop and redevelop in risky coastal areas. Finally, we have coastal property financing. This is a fascinating, relatively new aspect of understanding some of the dynamics in coastal development and redevelopment pre and post hazard. And in coastal property financing, you have the GSEs, the government supported enterprises. Fannie and Freddie are the common names that we know them by, which, this is a program that was created to expand home ownership by the federal government to lower incomes. So the government effectively takes over the mortgage and guarantees the mortgage, the underlying value of the asset itself. And this has been an amazing way in which you can provide home ownership opportunities to people that otherwise wouldn't be able to receive a mortgage for a variety of reasons, income levels, credit worthiness, etc., from regular private banking institutions, financial institutions. So the GSEs have been wonderful in terms of expanding the amount of home ownership availability to people in the United States. The unintended consequence vis-a-vis climate change and sea level rise here in coastal areas is that it provides a mechanism. It's to originate loans in risky coastal areas without private internalization of risk. Effectively, GSEs, Fannie and Freddie, right now, they do not require, so they don't ding you, is the best way to say it. They don't require any information on flood risk when they're determining whether a loan application is conforming, and they otherwise do not incorporate that risk into the valuation process of valuing the home. And so those two things are very difficult. And the consequences are we see more development. This is from recent work that's been done. Again, it's outlined in, or it's detailed to some degree in the paper. The recent work suggests that when pre-coastal hazard, natural disaster, you have background rates of conforming and non-conforming loans in a given coastal area. Post-disaster, you have a significant increase in conforming loans. And what that means is private mortgage originators, private companies are getting people to get loans that they can then, conform to Fannie and Freddie standards so they can off the risk of the loan. They basically transfer the risk of the mortgage over to Fannie and Freddie. They don't hold it themselves. So the level of that kind of lending goes up significantly, while the level of lending for the private market goes down. So they understand. What that tells you is that just like the private insurance companies under the NFIP, that private banking companies and finance companies understand the risks and are incorporating the risks of coastal hazards and finding other ways in which to profit off of development in risky coastal areas. How do we overcome these policy barriers? Generally, we need to acknowledge and address the unintended consequences of legacy policy barriers. We must see the connections between climate change, coastal resiliency, and current policies. Fundamentally, we need to rethink coastal risk assessment. Changes in policies will, over time, affect public perception. So there's this sort of confirming, positive feedback loop that you want to create where if we can rethink the way in which we assess coastal risks, through education and changes in policies, those things will sort of transform themselves over time into public attitudes and engender meaningful policy evolution. So you'll have that, what we call policy diffusion into the public. So it's not only at the higher levels, but into the public conscious as well. So that's really important in terms of changing the way people think about risk along these coastal areas, particularly in an era of climate change. Specifically, adverse selection and insuring and compensating losses, that's what we have right now. So both the federal disaster assistance, the de facto zero premium insurance that becomes, and the below market premiums being charged for the National Flood Insurance Program are ways in which we create, we discount the risk by externalizing all of that risk. And so what we need to do is get rid of that adverse selection and internalize the actual risk in pricing models and limit disaster assistance. Also, the overcapitalization in coastal home ownership. The GSEs, what's happening is that you're finding financing mechanisms that are being blind. They're making choices about development and redevelopment in areas where they're purposely making themselves blind to the risks, both the existing risk and the future risk of both development and redevelopment in these areas. So GSEs must incorporate flood risk into loan securitization process. That is an absolute. And in addition, originators must have skin in the game to prevent perverse incentives. Those private mortgage originators, those individuals, those companies, they need to actually be, have some responsibility and some connection. So it can't be a, heads I win, tails you lose situation for them, that they have to have actual skin in the game so that they have to incorporate the risk when they're originating the loan. They have to actually tell people and think more strategically and honestly about the risks of financing all of that coastal development. Thank you very much. Again, finally, just as a final point, the paper brings in a lot more information into this, and obviously will be available on the specified date and time in July to answer any questions. The only other point I'd like to make is we have another, it looks like we have another talk from some colleagues at the State University of New York System, SUNY, who are going to talk about recent work that they've been doing on understanding risk perception, which I think folds nicely into this discussion about the different kinds of policies that sort of misplace or help to disincentivize perceptions of risk. So I think there's a nice connection there if you're looking for it. Okay, thank you very much.